Hello. Good afternoon, everyone. How was lunch? And how much excited you are about this session? Are you looking for a sleep, a nap for the next session, or you are looking for the subject? Yeah, thank you so much. Thank you for being very kind. And I just proposed at the beginning to have this interactive session because non-resident taxation coupled with the TDS liability of TDS obligations, and it may be very complex, but we can discuss, we can interact, and let's not make it only one way. It means if it is two way, then it will be much fruitful for all of us. So 2008 globalization and the global crisis in USA. India was hardly impacted country despite the global recession and more so in USA. Now, as compared to 2008, if we look at in 2025 and today's scenario, everyone, each market of global countries are impacted by one news, which is a Trump tariff. Why so? Why India is so much impacted? If you compare 2008 and 2025, what has changed? Globalization has now become the reality of the fact, right? And the globalization is also having impact because we are having n number of transactions wherein our clients are dealing with the non-residents day in day out, and that's why the tax implications under the Income Tax Act and the TDS obligation under section 195 of the income tax are very important nowadays. I was discussing with one of the KPMG director, ex-director, and he mentioned that in 1991, when we started with the relaxation of the global foreign payments after the crisis, so Big Four were having hardly any practice in India as far as the tax practice is concerned. They were more into audit and other things. But after 1991, once the doors were made open for the global industries, for the investors, then they found the new investor coming into India. They got more opportunity to go global, and that's how Big Four developed their practice. And similarly today also, if we look at our practice, even though we are having a proprietorship firm or a small size or big size firms, so we come across different issues wherein our client come to us saying that what is the tax treatment on this foreign payment. So let's start with this background. So today's topic is global TDS navigating non-resident taxation and Form 27Q. Now, see, we are having today's seminar for the TDS, but what is the basis of TDS? What are the source of TDS provision? So for levy, you are having section 4, subsection 1, which imposes levy on the income of the assessee. Whereas section 4, subsection 2 says that where the income is chargeable under subsection 1, then the income tax shall be deducted as per the provisions of the Act. So this is the basic source of a section, the TDS provisions, the entire chapter. Now you are having chapter 17, which is dealing with the collection and recovery of tax. So ideally, the TDS is nothing but a recovery mechanism. So if the transaction is taxable, then there should be TDS obligation. If there is TDS obligation, as a deductor, we are paying the amount to the government, and government is having the recovery throughout the year. So that is the model. So initially, TDS was introduced as a model to recover the taxes throughout the year, not just waiting at the year end when people will file the income tax return. Subsequently, they realized that this is good tool to identify and catch the transactions, because nowadays people are having tendency, if something is not reported in 26 AS for AIS or TIS, then we are least bothered to report it as a part of our ITR. So now TDS has expanded, it has grown much more than what it was envisaged to be, and it is now a collection mechanism as well as a mechanism to ensure that the transactions are within the tax net and the taxpayers are honest enough to discharge their tax liability. So if we observe the chapter 17, then chapter 17 can be divided into three parts. First, payments to residents, a second, payments to non-resident, and general provisions. General provisions are dealing with the procedural requirement with respect to TDS and TCS liability. And right now for this session, we are more concerned about the second part, payment to non-residents. Now, one thing which we need to keep in mind is TDS is vicarious liability. Vicarious liability means what? So if there is a tax on the transaction on the recipient, then only there should be a tax liability to deduct TDS. So this is a fundamental. Of course, there are exceptions, but one basic principle is TDS is a vicarious liability. Now, what are which are the sections which are impacting payments to non-residents? So these are the list of the sections. Now I am bifurcating these sections into two parts. Section 195. 195 is the general sections whenever you are making a payment to non-resident. In other are special provisions. Let's say if you look at 194E, it is more related to non-resident sportsmen and sports association. Then 194LB, it is in the reference to infrastructure debt fund. So there are specific sections which are dealing with the payments to non-residents, and there are some section 195 is a general section which is dealing with the payment to non-resident. Now, for us, 195 is the crucial aspect where so other sections we can have a specific aspect, but they are having very limited implication in their sense. But if you look at 195, 195 is is if I compare 194C, 194J, 194H, 192, and all the provisions which are related to the payments to resident on one side and 195 on another side. So 195 is umbrella wherein any payment to non-resident unless otherwise provided, it will be covered under 195. So how 195 is worded? 195 says any person responsible for paying, then what? Interest or any sum chargeable under the provisions of the act, but exception salary and interest differ under specific provision like 194 LB, LC, LD, etc. To whom the payee should be non-resident, not being a company or a foreign company. And when I am supposed to deduct TDS? So at the time of credit or payment, whichever is earlier. At what rate? Then at the rates in force. So if we bifurcate entire section 195 in different parts, so let's begin with deductor. Who is supposed to deduct TDS under 195? Whether only resident or even non-resident making payment to another non-resident is subject to deduct TDS under 195? Answer is yes. If a non-resident is making a payment to another non-resident, then also it is subjected to TDS under 195. So we are having the classical situation of indirect transfer, right? Section 9, and a whole controversy revolving around Vodafone case, Kane India, and there it was indirect transfer. Non-resident purchasing shares of another non-resident from another non-resident. So three parties which were not resident in India, still it was considered as a taxable income in India under indirect transfer provisions, and then correspondingly 195 TDS provisions were made applicable by the department. So deductor, whether it is resident or non-resident, it is important to apply 195. Now on which transaction? So interest, of course, we understand section 228A defines interest, but any other sum chargeable under the provisions of the act. Now any sum would be called, it means it may be, let's say, commission income. It may be, let's say, purchase of immovable property. It may be, let's say, even purchase of goods. It may be any services of advocate. It may be anything, subject to condition that it should be chargeable to tax under this act. Now the question is, if we are having a comparison with other provisions, let's say a TDS on lottery 194BB, which says that if the payment is in kind, then also the deductor is supposed to make sure that the TDS is paid to the government, right? Now there is no such corresponding section under 195. However, there is one Supreme Court decision, and the matter before the Supreme Court was if the payment is in kind, whether section 195 will apply or not. Because normally if you consider the decision of Karnataka High Court in case of Hindustan Lever, wherein the issue was whether the TDS is subject to TDS is to be deducted on payments in kind or not, and the Karnataka High Court said no, TDS is not supposed to be deducted on payments in kind. But as far as 195 is concerned, Supreme Court in case of Kanchanjunga Seafoods held that if you are making a payment in kind, which is a constructive payment towards the services you have availed from a non-resident person, then the TDS is to be deducted. So this thing we should keep in mind. Then the question is, let's say, as far as non-resident we understand, but if it is a foreign company and the foreign company is having POEM in India, and by virtue of POEM, place of effective management and control in India, it has residence in India. So a foreign company considered to be resident in India by virtue of POEM in India. So in that situation, whether TDS under 195 will apply or not. Any idea from last? Let's say your client EBC is making payment to foreign company ALLC, which is having POEM in India and hence it is considered to be resident in India. Whether on this transaction, assuming it is chargeable to tax in India, whether TDS would be deductible under 195 or you will look at 194J, 194C, 194H and so on. Sorry, sir? 195. Why? Because here it is not only non-resident. Non-resident not being a company or a foreign company. As far as company is concerned, 195 is not restricted to only non-resident foreign company. It may be made applicable to even resident foreign company. So that's why it is very important to understand that you can not rely just based on the residences of any company. You need to understand whether it is a foreign company or Indian company. And if it is a foreign company, 195 would apply. Now the question is, we are having three kind of residency as far as individual is concerned: resident but ordinary resident, resident but not ordinary resident, and non-resident. So as far as non-resident is concerned, 195 will apply, very clear cut case. Resident and ordinary resident, 195 will not apply, very clear case. But the midway category, when the person is resident but not ordinary resident, so we are having two criteria for it. One, stateless residency, when you are Indian citizen but you are not resident of other country and you are deriving certain income from India, then you are considered to be resident in India, not ordinary resident. And secondly, you are not satisfying other conditions to be ordinary resident in India. In that situation, whether 195 will apply or you will go with 194C, 194J and so on. Any guidance? Individual, not ordinary resident in India. You are making payment to such individual, whether TDS under 195 will apply or let's say 194J, 194C will apply. Will not apply. Why so? Yeah. So for as far as 195 is concerned, there are only two categories: resident and non-resident. Then further in detail categorization of resident but not ordinary resident and resident and ordinary resident is not relevant. So far as a person is resident but even not ordinary resident, then also 194, 195 will not apply. Then the question is, at what rate I will deduct TDS? So if I look at 194C, they are providing 1% or 2% depending upon the nature of pay. 194J, 2% and 10% depending upon the nature of payment. But as far as 195 is concerned, they are saying the tax will be deducted at rates in force. Now the word rate in force is defined under section 237A, which says that for the purpose of section 195, the rates in force would be the rate as provided under the Finance Act or the rate as provided under Double Tax Avoidance Agreement, DTAA. So that's why whenever you are making a payment to a non-resident which is subjected to TDS under 195, it is important to refer the Finance Act book and not Income Tax Act book. Right? So every year the government comes up with budget, the finance bill then translated into Finance Act. So the Finance Act schedules provide for the rates to be applied for the purpose of rates in force. And then you also need to compare whether treaty benefit is available or not. The question is whether there is any threshold. So 194C provides a threshold of 30,000 and 1 lakh rupees, right? So whether any threshold is applicable as far as 195 is concerned, answer is no. Even you are making a payment of 1 rupees or 5 rupees or 10 rupees, then also 195 will apply. So in many situations of a non-resident who are having refund in India, income tax refund, and they are getting interest on such refund, Even it is 10 rupees, department is invariably deducting TDS at 30%, even though it is 10 rupees amount. Right? So TDS under 195 will apply without any threshold. Then the question is, what is sum chargeable under the provision of Act? And that's why we need to understand that how the tax liability is fastened on a non-resident person. And if you look at the traditional mechanism of levying tax, there are two criteria, either resident criteria or source criteria. If someone is resident of a country, then normally the global income is taxable in the residence country. But as far as a non-resident is concerned, only the income which is derived from source in the country will be taxable. So, as per Section 5 of Income Tax Act, a non-resident will be taxable in India on four count. First, income received in India. Second, income deemed to received in India. Third, income accrued in India. Fourth, income deemed to accrue in India. If your transaction fits into any of the four categories, then only it can be taxable in India. Now, it is important to understand how we can identify whether income is deemed to accrue or arise in India or not. Section 9 deals with this provision. Section 9 is very important as far as non-resident is concerned. Section 9 gives a criteria to levy tax depending upon the nature of income. So now when you are looking at Section 9, you need to first start with the classification of income. What is the classification of the transaction? So if the income is in the nature of business profits or business receipts, it will be taxable in the source country in India only if the non-resident is having business connection in India. And let's say if I am having business connection in India, whether entire receipt will be taxable in India, answer is no. If I am performing, let's say 10% activity in India, then only 10% of the profit will be taxable in India, not the entire amount. However, we need to understand what constitutes business connection in India. Section 9 is not defining it in so many words, but Supreme Court in case of R.D. Agrawal defined to say that if you are having live and proximate connection, continuous connection between your activities in India and your business operations outside India, then you are having business connection in India. Then depending upon the facts, one has to analyze whether there is a business connection or not. And recently, the government has gone one step ahead. Why so? The traditional provisions were made not to capture the tax on the traditional model of business. So if you started with 1961 Act, whether the legislator envisages that there will be a Amazon in future in 2025 who would operate from remote location but earning millions of dollars from India, answer is no. So the traditional business connection definition was not so wide to cover the non-traditional business models, online business models. So now they are having additional criteria of significant economic presence. Significant economic presence will also create a business connection in India. Now, how to identify whether the person is having business significant economic presence in India or not? So then there are two tests. First test is revenue threshold, and second test is user threshold. So if a person, a non-resident, is earning any receipt from India beyond the revenue threshold, then it will be considered as having a SEP, a significant economic presence in India. Similarly, even if I am not earning any income from India, but I am interacting with more than 3 lakh users from India, then also it will be considered as SEP and business connection in India. So that's why whenever you are making a payment to any non-resident, we need to first identify whether that person is having business connection in India or not, by virtue of the traditional model or by virtue of SAP. Then if the property is derived from property is situated in India, then any capital gain arising from transfer of such property will be deemed to accrue or arise in India. So assuming today if a non-resident is selling shares of Indian company, then the question is like in the era of demat accounts where I don't have the physical shares, how to identify citers of the shares? And the answer is, since the company is maintaining is register of members in India, and that's why it will be presumed that the companies or the shares are having citers in India, and hence a non-resident selling shares of India will be considered as a taxable event in India. Then salary income. If a non-resident comes to India, is performing services in India, then it will be taxable in India. Now consider a situation. The employer is Indian person, Indian company. But after COVID, The employee was allowed to work from remote location, let's say Spain. The Spain-based employee working for Indian company and he is receiving salary in his Spain account. He is not receiving salary in Indian account. Whether it will be taxable in India? Answer would be no, because your service performance is not related to the place where the contract is signed. Service performance is also not related to the place where the employer is situated. The service performance is more related to your physical presence, because as I repeated, in few seconds back, these provisions were drafted in traditional era where remote working was not envisaged at all. So the provisions were drafted in a manner to capture only your physical performance in a jurisdiction. Hence, if the service performance is happening from remote location outside India, then it will not be regarded as taxable in India by virtue of Section 9. Then royalty and fees for technical services, if it is paid by government, then it will be taxable in India. If it is paid by a resident in India, then normally it is taxable in India, except one situation. Except for a situation where such royalty or FTS, fees for technical services, are utilized for a business outside India. Contrary, a payment by a non-resident will normally not be taxable in India unless such services being royalty or FTS are utilized in India. So, let's say same goes with interest. If interest is payable by a resident person, normally taxable in India, except a situation where the funds are altogether utilized for a business outside India. So, these are the criteria under Section 9 to understand whether the income under the Domestic Income Tax Act is taxable or not. Once it is decided the income is taxable either on receipt basis or accrual basis in India, then the question is whether this is the the cutoff point or there is something to further explore. Now the actual story begins from here. So here Section 90 and Section 90A comes into picture, which says that Indian government can enter into an agreement with foreign country to provide relief from double taxation. Why so? Let's say a non-resident based in USA is earning income from India. By virtue of Section 9, it was taxable in India, and the non-resident foreign companies are taxable at 40%, now reduced to 35% in India. So 35% tax is levied in India. Now when he goes back to USA government is again asking money in form of taxes, and let's say that the tax rate is 25%. So after paying 35% taxes in India, someone goes back to the home and he is again asked to pay 25%, then effective tax rate is around 60%. So out of 100% profit, 60% is taken away by the government in the form of taxes. And this may reduce foreign trades, overseas transactions, and to promote the trade and investment across the borders, the governments have entered into double tax avoidance agreement under Section 90 and 90A, right? So we need to first understand if the income is taxable in India, whether there is any DTAA, double tax avoidance agreement, which gives me relief with respect to taxability. Now, let's say India has entered into more than 100 treaties with different countries, starting from USA, UK, Netherlands, Singapore, Mauritius, and so on. Now, USA resident is coming to India, earning income from India. Can I apply a treaty with Mauritius country? Answer is no. You need to first understand the residence country of the non-resident. So if the non-resident is having so non-resident is based in USA, then India-USA treaty will apply. So first we need to determine which treaty is applicable based on the residence of the payee. Once it is determined, then it is important to understand again the characterization of income, because the treaty gives tax relief based on the characteristic of income. Few income such as let's say business profits are not taxable in the source country unless the non-resident is having permanent establishment in the source country. However, royalty, FTS, fees for technical service, interest are normally taxable, but as gross level at flat rate of 5% or 10% or 15% or 20%. So, depending upon the nature of income, the applicable treaty provides the relief, and hence, when we are deducting TDS under 195, when we are identifying rates in force, we need to understand the treaty applicability and the relief or the tax rate provided under the treaty. Now, the question is, what are the the additional mechanism to understand the TT benefit is applicable or not? First, we will obtain the tax residency certificate of the payee to ascertain his residence. So, if a person is resident of USA, to apply USA India treaty, first we need to obtain the tax residency certificate of that entity. If the tax residency certificate issued by the US authority is not sufficiently covering all the particulars as prescribed by the government of India, then Form 10F is to be obtained online, which will also cover the other aspects which are not covered in the tax residency certificate. So that Form 10F along with Form TRC will be a gateway to access the treaty benefit. Now, in case of a business income, one has to obtain no P declaration. So why so? Let's say the non-resident is saying that he does not have permanent establishment in India and hence the income should not be taxable. Now, as a deductor, would you go by his words or you would obtain a documentation? So that's why no P declaration is very important as far as business income is concerned. Yeah. No, there is no format specified. Unlike TRC or Form 10F, it is just you need to take the declaration. So the declaration will mention that I don't have a permanent establishment under so and so treaty in India. No, no, no. Yeah, simply declaration, more preferably in English because means the vernacular language of the foreign country would not be relevant in India, right? Yeah. Yes, sir. Hmm. Hmm. Right. Yes. Yeah. So first, the transaction is taxable in India if you apply Section 9. Two criteria. First, business connection, assuming there is no business connection directly under traditional model, but SAP. If SAP is triggered, so it is having a business connection in India, then the income is taxable in India, right? Now, if something is taxable in India, unless you are having treaty benefit, you cannot say that I will not deduct TDS. So even if the Chinese entity, the counterpart is not providing TRC, then also the obligation will remain on the Indian importer only to deduct TDS. And in that situation, the question would be, okay, how I will deduct TDS because I don't have. Yes, sir. Yeah, so then of course this is a practical challenge. So no one will go with a deduction of 40% because the Chinese counterpart will also not accept 60% amount, right? Then it will be a question of net of tax arrangement. The Chinese entity will say, pay me 100 rupees, my consideration. I am less concerned about your Indian tax liability. Then as a deductor or as a payer, it will be responsibility under the income tax on the Indian entity to make sure the taxes are paid to the government. So this creates actual difficulty in the hands of Indian party. So that's why before entering into any of such agreements for purchase of any goods, it is very important to obtain requisite documentation including tax residency certificate and no PE declaration. One grace area is this transaction of import of payment is normally not captured by virtue of 15 CACB. So, so whenever we are making a payment to a non-resident person, normally the transaction is subject to reporting under 15 CSCB, and we need to declare the nature of transaction, whether it is for fees for technical services, dividend payment, royalty payment, and so on. But since this transaction is not subjected to reporting under 15 CSCB, so the detection risk is lower. But assuming in your case of scrutiny, the department asks you, you have made so many payments to a non-resident person in resident in China, and whether you have deducted TDS. If you are saying no, then there is a chance to disallow the expenditure, entire expenditure under Section 40A1. So along with the interest and penalty. So of course, it is a practical difficulty, and that's why before entering into an agreement, one has to clarify all these things. Normally, what we observe is people or the client will come to us only after executing the transaction, after executing the agreement, or even after making a payment, right? But then we need to educate our clients to say that whenever you are getting into touch with any of the non-resident clients or a supplier, just make sure that you are just reaching out to us. We are just a call away, right? Hmm. Ideally 40% is 35% is the rate, right? Yeah. So unless you are availing treaty benefit, surcharge and cess will apply. And that's why you need to deduct TDS at 35% plus surcharge and cess. In that situation, one alternative could be you can apply to the income tax authority, asking, sir, this is the situation. Then guide me for lower TDS or to identify what is the right TDS provision or right TDS quantum. See, if you look at Section 9 says that income will be taxable in India to the extent it is attributable to activities conducted in India, right? Now there is no formula to determine what is activity conducted in India, how you will attribute the income to activities conducted in India. Then Rule 10 is there, Rule 10 of 1962 rules, which says that it will be at the authority of the income tax department to decide based on the reasonable basis, of course, how much income is attributable to India. So even they cannot come up with the objective test that in such situation this could be the right way of attribution. So if department is also, the legislature can also not envisage how to attribute the income. Of course, they are also right. There can be n number of transactions and you cannot provide objective criteria for attribution. But in that situation, on a safer side, it is better to approach the department only. But a practical question is how much department will help you. Yeah, yeah. And then it is a practical. It is a risk arbitrage. I am aware that I have not complied with the provisions of the act. In future, if this get detected, then there is a risk of a disallowance, interest, and penalty. If I am running that risk, then I am aware about the risk which I am running. Okay. So when we are applying treaty, a few other aspects are to be evaluated is principal purpose test and limitation of benefit article also. So these are very specific nuances of the treaty. We are not dealing with them separately, but in some substance, the treaty benefit can be denied to a non-resident person if the transaction is executed with a principal purpose of tax avoidance. So in a cases of business restructuring, let's say A company is holding B company in Singapore. A was situated in USA, B is in Singapore, and C is in India. Then the entire structure is done in a way that you can avoid or reduce your capital gain tax liability or dividend tax liability. So department may challenge the entire structure, saying that where is the substance of the transaction. In Mauritius, you have just opened up a company without any employees, without any expenditure over there. Then what the Mauritius entity is doing over there? It is just interposed just to avail the benefit of India Mauritius Treaty and let's say USA Mauritius Treaty. In those cases, the Indian department may deny the benefit vis-a-vis India Mauritius Treaty. So the principal purpose test is also important. Now, there are so many countries with which India has entered into treaties. Similarly, there is, all across the globe, countries have entered into treaties with another country. So there are more than thousands of treaties entered by different countries with each other. And all those treaties are based on the traditional DTAA model of OECD and UN. And considering the requirement of evolving business models like Amazon, Flipkart, Facebook, now OECD and UN forums, the multilateral governments, they are coming together to understand that how we can evolve the taxing provisions, and they have come up with multilateral instrument under OECD Action Plan 15, which intends to amend or enhance the taxing power of the countries with a single instrument. So let's say if India is signatory to MLI and MLI, so India is signatory to MLI and let's say Singapore is also signatory to MLI. Both have notified that Singapore India treaty will be subjected to multilateral instrument. In that situation, India Singapore treaty will be subjected to changes by MLI. So in addition to the existing treaty, it is also important to understand the MLI implication. And the MLI implications are your capital gain transactions are subject to different taxing rights. Similarly, your dividend and permanent establishment criteria are also changed. We are not dealing with each of them in detail, but of course, these are the points to be evaluated when we are evaluating the rates in force and treaty applicability. Then, as we discuss, tax residency certificate, Form 10F, and no SCP or no PE declarations are important aspect. Now, consider a situation that the PE does not have PAN in India. You are making a payment to Alphabet. Alphabet is less concerned about taxability in India. It is saying that I will not obtain any PAN in India. If I am obtaining PAN in India, then I am supposed to file the annual returns. I am supposed to comply with the Indian government's regulations. I don't want to catch hold of I don't want to come within the tax net of Indian government, and that's why they are not taking PAN. In that situation, whether Section 206 AA, which provides for higher TDS rate in case of non-PAN pay, whether 206 AA will apply or not. Answer is yes. Even 206 AA can apply in a situation where the non-resident is pay or deductive. But one exception is there. If the payee has obtained TRC and the payee is providing the TRC, in that situation, 206 AA would not apply. And hence, it is very important either to ensure the TT benefit available, or a higher tax liability under 206 AA is not attracted. It is very important to obtain TRC, tax residency certificate. Of course, if you are not deducting TDS, the disallowance under 40A is waiting for you, and you will be exposed to 100% disallowance. Now I think it is very, TDS section is going very tedious, so we will move to case studies. The first case study, this is very interesting case study. Let's say there is a group of Indian company which is having 100 companies. So one holding company and 100 subsidiary companies. Each of the companies are having their own CFO, CEO, tax head, and other KMPs, key managerial persons, and they are flying outside India, in India, day in day out. So they want to have one dedicated solution for travel management. So let's say they are approaching Make My Trip. Make My Trip is saying, I will provide a platform. The platform will be integrated with your SAP, right? And whosoever your employee wants to book the tickets, either for air travel, either for rail travel, either for cab booking, either for hotel accommodation, everything can be done and dusted from my portal. In that situation, Make My Trip will first make a payment to non-resident or resident cab service provider or airline, and it will be reimbursed from the Indian entity, let's say on weekly basis or monthly basis. Now consider a situation, Mr. A, who is employee of this group, he wants to travel from India to Singapore. He will have a halt in Singapore for 2 days. From Singapore, he will travel to Delhi. He will travel to Dubai for another 3-4 days, and he will move back to India. So this is the transaction. He wants to book the ticket. He goes to Make My Trip portal. He first books the ticket of, let's say, Singapore Airlines from India to Singapore. Now the question is whether this transaction is subjected to TDS or not. So as we discussed, we start from section 9. Section 9, we need to evaluate whether there is a business connection in India or not. Apparently, if there is a starting point or end point in India, then the transaction would be considered as having business connection in India. So as far as the travel is concerned from Delhi to Singapore, the business connection test will apply, and it can be subjected to tax under section 9. If it is taxable under section 9, then the question is how I will deduct TDS. So that's why I will go to DTAA. DTAA says that in case of international airlines, it will be taxable only in the source country only if it will be taxable only in the residence country. Now I want to avail the TT benefit. First, who is supposed to deduct TDS? Whether Make My Trip, in our example, Exco is supposed to deduct TDS. Whether Exco is because Exco is making first payment to Singapore Airlines. Second question, if not Exco, because Exco is merely acting as an agent of Indian company, whether Indian company is supposed to deduct TDS? If yes, how they will ensure that the proper documentation is available? The criteria under 195 is person responsible for paying. Even though Exco is making payment to Singapore Airlines, right? Whether it is the person responsible for paying or it is making payment on behalf of Indian company, ECO. Any idea? So I would just like to touch upon 194C. The similar situation, CBT circular clarifies that in case of a air ticket booking, there is a privity of contract between the passenger and airline, and not the company which is reimbursing the amount to the employee. But that circular was issued in the context of section 194C and not in the context of 195. So question is whether I can bring in the privity of contract argument into this situation. Any idea? Let's say what happens if this is a corporate booking and ACO has negotiated with different airlines to say that if my employee is booking tickets, then you will provide 10% discount. Can I take argument that there is no privity of contract between ACO and Singapore Airlines? So, do you want to say that there is no privity of contract between ACO and Singapore Airlines? But then it is a privity of contract between company and Singapore Airlines, right? In that situation, how TDS would be deducted? So, Section 44 BBA of Income Tax Act provides for presumptive taxation in case of a non-resident airlines. Which says that if the flight starts from or ends to India, then on such transaction it will be taxable in India on presumptive basis. So the non-resident Singapore Airlines having a flight from India to Singapore is taxable in India under 44 BBA. If that is the situation, then without treaty, I would not be able to claim no TDS. And in order to avail the treaty benefit, I need to obtain TRC. Here between EXCO and ACO, ACO in case of a corporate booking is the entity who is who is responsible for making payment to Singapore Airlines. And hence it will be primary responsibility of ACO only to deduct TDS. On a contractual basis, they can ask EXCO to ensure that the documentation is properly maintained. But the primary responsibility will be on ACO only, and ACO cannot argue that EXCO has not complied with the provision and please catch hold of EXCO. Right? So in case of a corporate booking for foreign payments, it is very important to understand whether it is made through agent or not. And even if it is made through agent, then ultimately it hits to the debit of P&L account of company only, right? So if the department is asking why you are not deducted TDS, then merely the fact that it is routed through agent or other person would not be rescue from TDS liability. Now, second case study, similar situation. So ECO, an Indian company, is engaged in the business of manufacturing and selling petroleum products. ECO has installed data security software of non-resident IT companies, which are based in USA. Now you are making a payment to foreign IT companies, and there you are supposed to examine first whether TDS is applicable under Income Tax Act 1961 Section 9 or not, then whether there is any treaty benefit available in respect of this transaction. Third, what happens in case of net of tax arrangement? And fourth is, what if the amount is paid first by the employee of the company by his personal credit card, and then it is reimbursed to the employee? So how we will start? The transaction is taxable under Section 9 or not will depend upon first characterization of the transaction, whether it is in the nature of royalty under Income Tax Act or not. If it is in the nature of royalty, and if you look at section explanation 5 to royalty definition under Section 9(1), it is wide enough to cover use or right to use computer software. So if it is for right to use computer software and if it is to be treated as royalty in India, then the question is how I will not pay the TDS, and then I am supposed to refer treaty. For treaty, I need to obtain first TRC along with Form 10F if required. If I am availing TRC, then I need to look at the treaty benefit under India USA treaty. India USA treaty says royalty would be taxable in certain situation. Fees for technical service would be taxable only if it is made available to the recipient. So if it is taxable under domestic law as well as under treaty, then only it will be taxable in India. And if it is taxable in India, then TDS is supposed to be deducted. Now, in a case of net of tax arrangement, the service provider says that my consideration is 100 rupees. Pay me 100 rupees, bear tax liability in India on your shoulder. So, if I am supposed to pay 100 rupees, then under section 195A, the net of tax arrangement transaction, it will be grossed up. So, if 10% is the TDS rate, then I need to pay 11 rupees by applying the gross up rate. So it will be 111. I am applying 10% TDS and I am deducting 11 rupees as a TDS and paying 100 rupees to the service provider resident in US. Now, in a situation when it is paid by the employee through his personal credit card, the employee will say that I am not the person responsible for making this payment. The invoice is also in the name of the Indian company. I am just making payment on behalf of Indian company, and in that situation the company would be responsible for deducting TDS on this transaction. So many a times it has been observed that normally the company would involve any director or any senior person. A company will ask that senior person to have own credit card and swipe out the credit card for the payment of the non-resident transactions. Right? In accounting, how it will appear? It will be just reimbursement to Indian person, Indian resident, and probably the detection risk is low. But if it is detected, then it will be subjected to the complications of disallowance as well as penalty and interest exposure. Then another case study, ABC company is a partnership firm in India. Mr. A, Mr. B, and their son, Mr. AB, are three partners. Mr. A and Mr. B, Mr. A and Mrs. B are a resident in India, and Mr. B is resident outside India. In this question, the issue is the partnership firm is making payment of remuneration along with interest, along with profit sharing to Mr. B, Mr. AB, who is a resident outside India. Question is how I will deduct TDS. Whether section 194T, the recent provision will apply, or I will deduct TDS under 195. Sorry. Yes, sir. 195. And the basis of 195 is? And what is basis for that? So if you look at 194C, they are making specific reference to resident pay only. But 194T is not specifying whether the partner should be resident in India or not resident. So one view is since 194T is specific to remuneration payment to partner, irrespective of his residential status, in that situation 194T will apply. Right? Sorry. So far as remuneration is concerned. Yeah. But what about 195? Reason? Hmm. So we are entering into the battle of what is specific provision and general provision. Whether 194T is specific provision vis-a-vis this transaction or 195 is specific provision. If you go by the nature of transaction, 194T is specific provision. If you go by the nature of pay or residential status of pay, then 195 is specific transaction. Nah, he is settled outside India for more than 5 years. So, huh, nah, if a person is resident but not ordinary resident, then the income which is controlled from outside India will be taxable in India, right? But that is not criteria to determine whether that person is resident but not ordinary resident or not. I will apply section 6 first, and then I will go to section 5 to determine the taxing rights in India. If he is resident but not ordinary resident, then I agree. But if he is not resident at all, then that criteria will not apply. So recently, when 194T was introduced, before that, what was the position? Whether this transaction was subjected to TDS, first remuneration, whether remuneration paid to a non-resident working partner before introduction of 194T was supposed to deduct TDS in India. Why not? If you look at 195, 195 says any sum chargeable to tax under provision of this act, remuneration paid to a partner, which is deductible in the hands of the partnership firm. Isn't it taxable income in the hands of partner? If it is taxable in the hands of partner, right, under the domestic law, then you will of course refer to treaty. And if then the question is whether it is business income or it is other income. What is the classification of that remuneration in the hands of partner? Business. But if you recollect, there is one recent Bombay High Court decision, I think 1 or 2 years back. The partner was receiving remuneration from the partnership firm more than the tax audit threshold, and the lady was asked to pay penalty for non-compliance of tax audit requirement. And the High Court said that even though the income is classifiable as business profit, PGBP income, but you are not running the business, and that's why no penalty can be imposed on a partner not getting his accounts audited, even though the remuneration crosses the threshold of tax audit under 44AB. So can someone apply this argument to say that the partner is not actively engaged in the business? It is the partnership firm which is running the show, running the business. Sorry. And let's say if assuming for a moment 194T is applicable, it provides a specific rate of 10%. Then can I go to treaty saying that, see, this is my business income, I don't have P in India, then it should not be taxable in India. Whether 194T allows me to refer to the treaty provisions? Sorry. Irrespective, chargeable to tax in India or not. So then would we go back to section 4 subsection 2, the first point of our discussion today? What is the origin of the withholding provision? Section 4 subsection 2 says if income is chargeable to tax under subsection 1 of section 4, then in respect of such transaction, the taxes would be deducted and collected as per the provision of this act. So if the income itself is not chargeable to tax by virtue of treaty, can I simply go to section 4 subsection 2 to say that now no more provisions of withholding under 194T would apply? Now the contrary is Supreme Court decision in case of Pilcom, which was a situation of payment with respect to 1996 World Cup to one association formed by Sri Lanka, India, and other cricket associations. Their Supreme Court said that 194E is not referring to treaty anywhere. They are just providing a simpliciter rate, and there you don't need to apply the treaty provision. Even though it is not taxable under treaty, still you will follow 194E. Yeah, yeah, but that is the Supreme Court decision. So yeah, but see, if you are a Mr. EV who is receiving remuneration, who is also subjected to TDS by EBC company, then he always can take argument that this income is not taxable in India by virtue of treaty provision, and that's why I will file the return. I will claim the refund of entire amount. But as a partnership firm, whether you are supposed to deduct TDS, so since 194T is a recent provision, so both views are going on right now. But so far as remuneration is concerned, if someone takes view that I will decide what is specific provision based on the nature of transaction, then 194T is specific. But before 194T also, if it was taxable remuneration and if treaty benefit was not available with respect to the transaction, then in any case it was subjected to deduct TDS under 195. So whether there is any legislative intent not to apply 195 and apply 194T in case of a non-resident partner, not emerging from the memorandum or any other reference material. Now consider situation of profit sharing. Profit sharing is not taxable under section 10, like right. So profit shared by partnership from two partner is not taxable. On this transaction, whether TDS will be deducted. Before that, question is whether 194T will apply or 195 will apply, or none of them will apply. Yeah, so 194T is just referring to remuneration. It is not dealing with the profit sharing. So 194T will not apply. To apply 195, the income should be chargeable to tax under the domestic law. If income is not taxable to tax under the because of section 10 exemption, then it should not be subjected to TDS at all. So there you don't need to refer even treaty benefits. So in a case of a non-resident being partner, normally the transactions are structured in a way that those partners are not given remuneration. The remuneration is normally paid to Indian partners, and the Indian partners are all, of course, now subjected to TDS under 194T. And if there is a profit sharing to non-resident partner, then 195 will also not apply because it is exempt income. Now, case study 4, purchase of immobile property. Mr. A is Indian citizen, is now tax resident of USA since last 10 years. He is having one ancestral property in India, and now he wants to sell off that ancestral property to Mr. B. Mr. B is a resident in India. In this question, the issue is how we will determine the TDS liability. At what rate? Whether 194 IA will apply or 195 will apply. 195. Then domestic law will apply. So, but domestic law means 195 will apply or 194 IA will apply. 194 IA. Okay. So 194 IA is also referring to P being a resident person. So as far as immobile property is concerned, It is having citus in India, so that's why it is taxable under Section 9 of Income Tax Act. Having said that, when I am referring to TDS provision, 194 IA is not applicable to non-resident pay, so I will refer to 195. Since it is chargeable to tax in India, 195 will be applicable. Now, for the purpose of rates in force, I will go to treaty. I will go to Finance Act. There are certain treaties which may grant the tax relief in respect of this transaction, but if the treaty is not granting tax relief, and treaties normally, as far as capital gain article is concerned, treaty is just defining the taxing right. They are not providing tax rate. So as far as 194, the capital gain is concerned, if it is taxable under treaty, I need to come back to the Finance Act to understand what is the rate in force. And normally the rate in force for transfer of immovable property is 20%. So 12 and a half. Yeah, so now reduced to 12 and a half. Earlier it was 20%. And that's why it will be subject to TDS at 12.5%. So if the non, so that's why it is very important to understand who is the seller. If it is a seller is a resident person, then 1% TDS would be applicable under 194 IR. But if non-resident is the seller, then it will be increased to 12.5%. Right? Now you are advising to a company, a group which is having good establishment in India, which is having good market presence in India, and they want to go global. Now, since they want to go global, they are not aware about the foreign connects, foreign markets. So they are hiring one agency abroad. The foreign agency is supposed to do the market research. They are also supposed to undertake the sales transaction on their behalf. So they are being paid two considerations. First consideration for understanding the market and providing the market survey along with their suggestions. What can be good for, what is good for this market, what is sellable, what is not sellable, what is customer preference in this market, and so on. And second, whatever sales is generated, the commission would be payable. Now the question is how the TDS will be applicable on this transaction. Why so? But you are now going to do the exports. So you are setting up your presence in overseas market. So even though you have manufactured goods in India, but the goods so manufactured by you in India would be sold outside India. Services are rendered outside India, but it is utilized by a resident person. Then why Section 9 would not apply? No, that is a criteria for employee. I agree. But as far as fees for technical services are concerned or other services are concerned, then what are the criteria? If it is a fees for technical service, assuming in this situation, because they are providing consultancy services or marketing managerial services, in that situation, if it is paid by a resident person, then normally it is taxable in India, with only exception that if the services are used for business outside India or source outside India, then it will not be taxable under Section 9. So what is your answer? Whether it is used for business outside India or how you will consider it? Then there is no entity outside India. Yeah, yeah. No, so if you are having branch over there, then so in which situation you will say that business is also outside India? You are a resident person. You are making payment to a non-resident person. In all the situation, the resident would have some business in India also. Then he is trying to expand overseas, but he is having the business in India for sure. Everything is collated into the financial statement of Indian entity. If there is a separate entity, then it is altogether not deductible in the hands of Indian entity, right? Because it is expenditure for that foreign entity. So here, since you are trying to set up business outside India, so for the purpose of Section 9, you need to consider two separate business, one in India, one outside India. So transactions which are related to your setting up of business outside India or any sales or any other business activity outside India, it will not be taxable in India under Section 9 because such services are utilized for business outside India, right? Now, many a times what happens, let's say there is one large group, they incur some common expenditure for let's say advertisement, for let's say server fees or server cost, or let's say uh, procuring the cloud services. So one parent entity will avail all those services. The subscription will be passed to the group entities. So one common cost incurred by the parent entity, and then it will cross charge to different group entities based on number of users or based on some other cost centers. In those cases, assuming that the group entity is having headquarters in UAE, UAE has incurred the expenditure, and then it is cross charged to Indian entity. And the transaction is such that if the payment was directly made by Indian entity, it would have been taxable in India. Then the question is when Indian entity is reimbursing the cost to the parent without any markup, then whether this transaction is subjected to TDS in India. If Indian entity would have borne the expense directly, they were supposed to deduct TDS. But now the group entity is availing these services because of economies of scale, because of some discount available on large scale, and it is now getting reimbursed based on certain parameters. If it is, yes, sir. Hmm. Hmm. So assuming that the transaction is FTS, fees for technical services, then I don't require physical presence in the form of P, permanent establishment. In that situation, even though service provider is outside India, but since the income nature is fees for technical services, I need to consider taxability in India, applying Section 9, that the payment is made by a resident person in India. It is utilized for Indian business purpose. Yeah, so as far as the marketing fees are concerned, commission is concerned, you can take a stand that the services are given outside India, services are utilized for business outside India, and hence it is not taxable in India. I agree with you. I am taking another example. Group entity is incurring expenditure for let's say 1000 users, and 10 users from Indian subsidiary are utilizing that service. So total cost was 1 lakh divided by 1000 into 10. Accordingly, the cost was charged cross charged from Indian entity. Whether this transaction is supposed to bear any withholding in India or not. The reason being, but sir, it will see as far as marketing is concerned, it is a different service. But as far as let's say if you are availing the server system or other subscriptions, if I would have direct made payment to the non-resident service provider, then I was supposed to deduct TDS. But because of the savings on account of large subscription discount I am getting, the a parent or intermediate parent is subscribing to the services. and then based on the number of users, they are cross charging to individual entity in respective countries. Concept of principal agent will not apply over here. The reason being, the let's say UAE entity avails the services and they inform that we have availed these services. If you want to use this service, you can have the user access. It is not that on behalf of Indian entity UAE is making payment. It is UAE entity's mandate that now we want to go digitalize. So we are taking the system online. That's why we are subscribing to these services. So the argument could be, I am just reimbursing the cost. The reimbursement of the cost can never be income in the hands of recipient. If it is not in the nature of income in the hands of recipient, then where is the question of withholding TDS in India? And the counter question is, if I would have made direct payment to foreign entity, foreign service provider, if it is subjected to withholding in India, the interposing entity would help me to prevent withholding in India. Then every time I will interpose one entity overseas, I will create one structure in UAE, and every transaction would be routed through UAE entity only. So Bombay Tribunal, in case of CU inspection, ITED took a stand that if the transaction, the underlying transaction is taxable in India, interposing an entity would not help you to avoid the withholding liability. So if the underlying transaction is taxable, deduct TDS irrespective who is first making payment to the non-resident person. But in this question, the issue is how you will ensure, how UAE entity will ensure that how much withholding is to be done in India, in Pakistan, in China, or all the countries in the region. So before CU inspection Mumbai Tribunal, practical view was taken that reimbursement is not taxable. But after CU inspection, it is very important to apply treaty provisions, at least to ensure that this transaction is not subjected to TDS and subjected to treaty relief. And if treaty relief is not available, then TDS is to be deducted on conservative side. Then many a times non-residents are having transaction with associated enterprise, which is subjected to transfer pricing provision. If you avail services of 100 rupees at a transaction price, and now the revised transfer pricing value is 120 rupees. On 100, whenever you made payment to foreign entity, you deduct TDS at 10%, assuming 10% is the withholding rate, and you remitted 90 rupees to foreign entity, foreign AE. Now, after the excess of transfer pricing, the arm's length value is 120, so 20 rupees is to be now payable. Now, on this 20 rupees, there can be two consequences. Till now, people were not making payment of 20 rupees, and 20 rupees was, let's say, disallowance in the computation of your income, because or it will be addition to the ITR of non-resident person, but it was never paid to non-resident person. Now, as per the provisions of secondary adjustment, if you are not making payment of the adjustment by virtue of transfer pricing provision, then it will be subjected to additional burden, additional interest liability. It will be treated as if it is a loan given by one AE to another AE. And hence, after this secondary adjustment requirement, one is forced to make a payment of this transfer pricing adjustment. The question is whether I am also supposed to deduct TDS on this transfer pricing element. Earlier, when I made payment of 100 rupees, I deducted TDS at 10%. Now it is increased to 120. So whether on payment of that additional 20 rupees, I am supposed to deduct TDS, right? So that additional 20 rupees will also bear the TDS liability. And what will be the nature of the transaction? The same as the original transaction. So if the original transaction is fixed for technical services, if there is a transfer pricing adjustment, then that additional 20 rupees would subject it to withholding, right? Yeah, right. Hmm. Hmm. Now, so since I am making payment to my EE, right? Now that is deemed to be loan for the purpose of secondary adjustment. But how the loan has arisen? Your transaction was 100, actual transaction. Now it is deemed to be 120 because of transfer pricing provision. So the value is now inflated to the extent of 20 rupees. Now, when you are making payment of 20 rupees, then whether it will have the same nature of transaction, FTC, FTS मैंने लिया था, fees for technical service I avail from my non-resident EE, then the 20 rupees additional I am paying, that is also in the same nature towards the FTS only. Then even though secondary adjustment is a deeming fiction to say that if you are not making payment in specified time limit, then it will be subjected to further interest liability, right? But the transaction, underlying transaction remains the same, the nature of transaction remains the same, then why the 20 rupees should not be subjected to TDS liability? So, okay, so I think I am having just, yeah, CU inspections. So Indian entity made payment to non-resident person just as a reimbursement of the expense actually incurred by the non-resident. In that situation, the argument was since I am just reimbursing the cost of the PE payer, so that's why it should not be subjected to TDS because the reimbursement is never in the nature of income. But the tribunal went into the underlying transaction by virtue of interposing one entity, whether you are avoiding the withholding liability in India. If answer is yes, if the direct payment was subjected to TDS in India, then why the indirect payment should not be subjected to tax in India? Yeah, right, right. So, so here I am deducting. Okay, so then two questions. Whether I am deducting TDS in the name of the underlying third party or I am deducting TDS with respect to the intermediate UAE entity, right? So the question is whether the UAE entity is providing me any services or the services are provided by the third party. So depending upon the agreement, of course, the agreement is entered by third party with UAE entity. So there I can take argument that I am not part of the contract. There is privity of contract between the non-resident third party and UAE entity. So I cannot deduct TDS vis-a-vis third party. But then I am supposed to deduct TDS vis-a-vis the UAE entity. Now the important question is if I am deducting TDS vis-a-vis UAE entity and UAE entity UAE treaty is providing me relief and the third party was resident of Netherlands, Netherlands treaty was not providing me the relief. So if I would have made direct payment to Netherlands, then as per treaty it was taxable and I was supposed to deduct TDS. But since I have interposed UAE entity and now I will apply India UAE treaty, in that situation, India UAE treaty is not taxing this transaction. I'm just taking examples, but in that case, I'm not supposed to deduct TDS. Then can I rely upon such a, India UAE treaty? And that it will open another Pandora's box where whether you are doing treaty shopping by interposing one entity in a jurisdiction which provides a favorable treaty arrangement, whether you are instead of applying India Netherlands treaty, you are applying India UAE treaty to avoid the withholding in India. Yes. Hmm. So if that entity does not have PAN, then a TRC can be used to deduct TDS. Hmm. Yeah. So question is के 120 rupees which was actual 100 was the actual transaction price, 120 is transfer price value. Now I am not okay, so I am not increasing my expenditure, but I am supposed to make payment to that foreign entity. uh, it will be secondary adjustment. No, if I am not remitting that amount, then it will lead to secondary adjustment. So 100 rupees I have already paid. What it's saying, if the transfer pricing is 120, okay, I will check. If I'm incorrect, I will correct myself. Okay, so any other question? Okay, thank you so much for having a patient hearing. Thank you so much.